of the business, I will have to. Before we start understanding the nuances of valuation, let's start by understanding what is an investment and why do we need to perform valuation. To put simply, of funds or capital into an asset class to derive returns. When we are buying or selling of an asset, we need to know that the price we are paying is a fair price, or not. Hence the valuation is done in the context of making an investment. Now, there are numerous asset classes available in the markets where investors can deploy their capital. Some of them are plain vanilla type ones, such as equity and bonds, or some are complicated, complex, structured products, such as a CDO. Now, depending on the complexity of the products, the investor class will also vary. Other investment assets where you will see a lot of retail and high net worth individual interest is real estate. This can be residential, commercial, or industrial. Also, this can be direct investing, basically where you buy a property. Or it can be indirect investing, wherein you do not buy the property directly, but instead, you buy shares of real estate developer companies or REITs. When you have made an investment into an asset, you expect some kind of returns. This means, the value of the investment should increase during the time you hold the investment. So the next question is, how much should the returns be? Returns that you expect as an investor will depend on numerous factors. Some of the most important ones are listed here. Number 1. Time period of investment. This is also known as holding period. Longer the time period you are expected to hold on to an investment, higher is the possibility of something going wrong with the investment. Therefore, higher will be the expected risk, and thereby, higher is the expected return too. In fact, this is the reason you will see the rate on a 3-month fixed deposit with your bank to be lower than a 3-year fixed deposit. Second factor is the expected inflation in the economy. When you buy some shares, bonds, real estate, you are moving your capital away from consumption. This deferment of consumption should get compensated. Why? Consider you have 100 rupees with you right now and you decided to park that money into some previously discussed asset class. Assume you hold on to for 2 years. The goods and services which you could have bought today with 100 rupees will cost more after 2 years. This is due to inflation in the economy. So your investment of 100 rupees today should at least grow to exceed the inflation. Now the third point. It is the uncertainty associated with the investment. For example, you invest into equity of a firm. The firm may go through difficult times. They may not be able to achieve growth targets they projected. When you bought some bonds, debentures, you expected that the company will make timely payment for interest and principal. There may be a situation that the company does not have sufficient cash flows to meet these obligations. Therefore, all investments come with uncertainties. Degree of uncertainty will vary across investments, but you cannot eliminate them completely. This is a risk which needs to be adequately compensated. That's why we have a risk-reward matrix quite popular in finance. Higher the risk, higher the expected returns, and vice versa. Now, this is an indicative chart of risk and return across various asset classes. Here we have considered 2 popular asset classes, namely equities and debt. Within each, we have shown the comparison for a number of sub-asset classes. For example, in equities, you will see small cap stocks, large cap stocks, international stocks, private equity, and venture capital. On X-axis, you have risk of each investment, as you move away from zero, risk increases. On y-axis you have expected returns. Again, as you move up from zero, expected returns increases. This is done keeping in mind the US context. Short-term Treasury notes have the lowest risk, and at this stage, the interest rate the short-term Treasury notes is close to 0%. As you keep moving up on this line, the expected risk and return increases. For example, the long-term Treasury notes carry higher risk because of duration. Large-cap public stocks have higher risk and return compared to bonds. International stocks have a higher risk than small-cap US stocks because of foreign currency risk. Venture capital is shown on the extreme side as they invest into firms which are very early in their life cycles, and there is a major possibility of them failing. Just to put some numbers out, expected returns by private equity investors is close to 20 to 25%. The same for venture capital investors is 35% to 40%. Let us look at some of the reasons you have to perform valuation. Number 1. When you are acquiring a business. Whether you are a private equity investor, a public equity investor, or a strategic investor. Whenever you make a decision to acquire some shares, some percent stake in a firm, or a company in full, you have to perform valuation to ensure that you are not overpaying. Number 2. At the same time, the seller will do the valuation of the entity to ensure that he is getting a fair price. Third, when you are raising growth capital, you have to dilute your equity in the return for the money you raise. Now, the amount of equity dilution versus amount of cash you raise will be a function of the current valuation of your firm. Fourth, as equity research analysts, their job is to analyze firms, value them, and based on their valuation work and the current share price, recommend either a buy, sell or a hold action. Fifth, issuing ESOP. When you issue stock options to your employees, you are replacing the potential cash payouts in the form of salary or bonus with these options. Now, for you as a firm or for your employees, there is a need to understand the valuation of the firm and the value of each share, to understand the worth of these ESOP issued and allocated to them. Sixth, is when you are doing a goodwill impairment test. When you acquired a business in the past by paying an excess price over that business's book value, you recorded the excess value as goodwill. Now every year you need to do the valuation of the unit you acquired to see that the value has not dropped. If it has, you need to write down the value of this investment and show an impairment loss on the income statement. Hence, for this reason too, you will have to value your acquired asset periodically. Now let's look at some of the core factors that help generate value for a firm. Are these the only factors which